Fedbank Financial, that's the one in focus, given that there are lots of earnings to number crunch as well. Anil Kothuri, the MD and CEO, joins in on the show right now. Anil, hi, good morning. Good to have you on the show. Firstly, let me talk about, the interest expenses that went down this quarter despite stable rates, which are further expected to remain at same levels. So what's really led to this contraction?
There have been two developments over the last 3 months. The first is that all our IPO money has come in, so therefore, we've had to borrow less. So that is one development that has happened. The second development is that we've received a rating upgrade, and we are rated now AA plus, okay, by both CARE and India Ratings. CRISIL has rated us AA with a positive outlook. So all of this has ensured that that our borrowing rates continue to be at what they were approximately. So therefore, our interest expense was lower in the quarter gone by compared to the previous one.
But Anil, what about the quarters going forward? Will you be able to maintain low interest expense in the coming quarters too?
We are hopeful for the reasons that I've mentioned. The impact of the rating upgrade hasn't yet played out, given that it's of less than 3-month vintage. The second thing is that we have a large gold loan book, which has an extremely short maturity, 4 or 5 months. So that gives us the wiggle room to borrow at the short end of the tenors. We can use commercial paper to borrow, and it's widely expected that the rates on commercial papers will ease prior to the long-term rates. So as and when that happens, we can borrow through commercial paper, and that could have a beneficial impact on our cost of borrowing.
Fair enough. Morning, Anil. And I want to understand a little bit more because you had guided the last time about credit costs of 0.8% for Q4. That came in at 0.7% lower than what was guided, which is a positive. So for FY25, what's the target in terms of credit costs?
We believe that our model is architected to give us a standard through the cycle credit cost of about 0.8%. And we will strive to do better than that in specific quarters, but the guidance is that we will be at 0.8%.
We've been seeing that you've reported a very healthy ROA ever since your listing, from around 1.3 in FY21 to the current levels of 2.4. From now on, what are the levers you think which could further result in an uptick in your ROAs?
There are three reasons why our ROA could trend up from here on. The first is that operating leverage will play out. Okay? We have now 4,000 people, a fully built out platform. We have the ability to originate a significant amount of loans. And as the balance sheet grows, our costs will not increase in the same proportion. So therefore, that's one reason the ROA can go up. The second is the fact that we have an off-book strategy. We are right now at just shy of 19% off book. And as that number creeps up, the denominator, that is our asset base, will be lower as a proportion. So that will take up the ROAs. And the third reason is that if the expected benefit in terms of short-term interest rate easing plays out, then that could benefit ROAs. So through a combination of these three reasons, the ROAs could go up in over the next year or so.
What about the outlook when it comes to your product mix? In the last 5 years, the business loan has seen a healthy uptake. Now it looks like more of a balanced portfolio with 85% secured. So any optimal mix that you're eyeing when it comes to profitability?
So the mix that we have will more or less be stable. There's an upward bias as far as small ticket mortgages are concerned. You'll see that small ticket mortgages are comprised now 29% of our assets on book. That will keep trending up because that has the highest behavioral tenor of 8 years. All other products have a shorter behavioral tenor. So the balance sheet will continue to get enriched to the extent of small ticket loans, small ticket mortgage loans. And we expect to take that up by, let's say, between 3 and 4 percentage points every year here on.
Okay. The last thing that I want to understand is that, given that we're almost into elections now and more than 50% of your AUM is attributed to the southern parts of the country, how is it that we should expect Q1 for your business?
We've had a healthy start to Q1, given that 1 month is almost done. Uh, a few things, a few tailwinds that we have. The first is that our customers are small self-employed customers. They borrow for working capital, and that kind of demand is evergreen. The second is that we have a gold loan business where the rising prices of gold are giving it some advantage in terms of the ability to lend more to existing customers. So for these two reasons, we believe that growth in Q1 will be good and probably a tad better than a normal Q1 in any other comparable year.
All right, appreciate your time. Thank you for sharing with us some of those benchmarks as well.
If you like this video, then like, share and subscribe to ET Now.